you very much, Lisa, and it's great to be back here at NABE today. So at the Fed, we like to say that monetary policy is data dependent. You may have heard that from time to time. And we say this to emphasize that policy is never on a preset course and will change as appropriate in response to incoming information. But that does not capture the full breadth and depth of what data-dependent decision-making means to us. From its beginnings, more than a century ago, the Federal Reserve has gone to great lengths to collect and rigorously analyze the best information to make sound decisions for the public we serve. And the topic of this meeting, trucks and terabytes integrating the new and old economies, captures the essence of a major challenge for data-dependent policymaking. We must sort out in real time, as best we can, what the profound changes underway in the economy mean for issues such as the functioning of labor markets, the pace of productivity growth, and the forces driving inflation. Of course, issues like these have always been with us. Indeed, 100 years ago, some of the first Fed policymakers recognized the need for more timely information on the rapidly evolving state of industry and decided to create and publish production indexes for the United States. Today, I will pay tribute to the 100 years of dedicated and often behind-the-scenes work of those tracking change in the industrial landscape. I'll then turn to three challenges our dynamic economy is posing for policy at the present. First, what would the consequences of a sharp rise in the price of oil be for the U.S. economy? This question, which never seems far from relevance, is again drawing out our attention after recent events in the Persian Gulf. While the question is familiar, technological advances in the energy sector are rapidly changing our assessment of the answer. Second, with terabytes of data increasingly competing with truckloads of goods in economic importance, what are the best ways to measure output and productivity? Put more provocatively, might the recent productivity slowdown be an artifact of antiquated measurement? Third, how tight is the labor market? Given our mandate of maximum employment and price stability, this question is at the very core of our work. But answering it in real time in a dynamic economy, as jobs are gained in one era but lost in others, is remarkably challenging. In August, the BLS announced that job gains over the year through March were likely 500,000 lower than previously reported. And I will discuss how we're using big data to improve our grasp of the job market in the face of such revisions. These three quite varied questions highlight the broad range of issues that currently come under the simple heading of data dependence. And after exploring them, I will comment briefly on recent developments in money markets and on monetary policy. So our story of data dependence in the face of change begins when the Fed opened for business in 1914. World War I was breaking out in Europe, and over the next 4 years, the war would fuel profound growth and transformation in the U.S. economy. But you could not have seen this change in the gross national product data. The Department of Commerce did not publish those until 1942. The Census Bureau had been running a census of manufacturers since 1905, but that came out only every 5 years, an eternity in the rapidly changing economy. In need of more timely information, the Fed began creating and publishing a series of industrial output reports that soon evolved into industrial production indices. These indices initially comprised 22 basic commodities, chosen in part because they covered the major industrial groups, but also for the practical reason that data were available with less than a 1-month lag. The Fed's efforts were among the earliest in creating timely measures of aggregate production. And over the century of its existence, our industrial production team has remained at the frontier of economic measurement, using the most advanced techniques to monitor U.S. industry and nimbly track changes in production. So turning to the three questions. The first is the consequence of an oil price spike. Figure 1 shows U.S. oil production since 1920. After rising fairly steadily through the early 1970s, production began a long period of gradual decline. By 2005, production was at about the same level as it had been 50 years earlier. Since then, remarkable advances in the technology for finding and extracting oil have led to a rapid increase in production to levels higher than ever before. In 2018, the United States became the world's largest oil producer. Oil exports have surged, imports have fallen, and the U.S. Energy Information Administration projects that this month, for the first time in many decades, the United States will be a net exporter of oil. As policymakers, we closely monitor developments in oil markets because disruptions in these markets have played a role in several U.S. recessions and, of course, in the great inflation of the 1960s and 70s. Traditionally, we assessed that a sharp rise in the price of oil would have a strong negative effect on consumers and businesses, and hence on the U.S. economy. Today, a higher oil price would still cause dislocations and hardship for many, but with exports and imports nearly balanced, the higher price paid by consumers is roughly offset by higher earnings of workers and firms in the U.S. oil industry. Moreover, because it is now easier to ramp up oil production, a sustained price rise can quickly boost output, providing a shock absorber in the face of supply disruptions. Thus, setting aside the effects of geopolitical uncertainty that may accompany higher oil prices, we now judge that a price spike would likely have nearly offsetting effects on U.S. GDP. Turning to the second question of how to best measure output and productivity. While there are some subtleties in measuring oil output, we do know how to count barrels of oil. Measuring the overall level of goods and services produced in the economy is fundamentally messier because it requires adding apples and oranges and automobiles and a myriad of other goods and services. The hardworking statisticians creating the official statistics regularly adapt the data sources and methods so that, insofar as possible, the measured data provide accurate indicators of the state of the economy. Periods of rapid change present particular challenges, and it can take time for the measurement system to adapt to fully and accurately reflect the changes in the economy. The advance of technology has long presented measurement challenges. In 1987, Nobel Prize-winning economist Robert Solow quipped that you can see the computer age everywhere but in the productivity statistics. In the second half of the 1990s, this measurement puzzle was at the heart of monetary policymaking. Chairman Alan Greenspan famously argued that the United States was experiencing the dawn of a new economy and that potential and actual output were likely understated in official statistics. Where others saw capacity constraints and incipient inflation, Greenspan saw a productivity boom that would leave room for very low unemployment without inflation pressures. In light of the uncertainty it faced, the FOMC judged that the appropriate risk management approach called for refraining from interest rate increases unless and until there were clearer signs of inflation. Under this policy, unemployment fell near record lows without rising inflation, and later revisions to GDP measurement showed appreciably faster productivity growth. This episode illustrates a key challenge in making data-dependent policy in real time. Good decisions require good data, but the data in hand are seldom as good as we would like. Sound decision-making, therefore, requires the application of good judgment and a healthy dose of risk management. Productivity is again presenting a puzzle today. Official statistics currently show productivity growth slowing significantly in recent years, with growth in output per hour falling from more than 3% a year from 1995 to 2003 to less than half that pace since then. Analysts are actively debating three alternative explanations for this apparent slowdown. First, the slowdown may be real and may persist indefinitely as productivity growth returns to more normal levels after a brief golden age. Second, the slowdown may instead be a pause of the sort that often accompanies fundamental technological change, so that productivity gains from recent technology advances will appear over time as society adjusts. Third, the slowdown may be overstated, perhaps greatly, because of measurement issues akin to those at work in the 1990s. At this point, we cannot know which of these views may gain widespread acceptance, and of course, monetary policy will play no significant role in how the puzzle is resolved. As in the late 1990s, however, we're carefully assessing the implications of possibly mismeasured productivity gains. Moreover, productivity growth seems to have moved up over the past year after a long period at very low levels. We do not know whether that welcome trend will be sustained. Recent research suggests that current official statistics may understate productivity growth by missing a significant part of the growing value we derive from fast internet connections and smartphones. These technologies, which were just emerging 15 years ago, are now ubiquitous. We can now be constantly connected to the accumulated knowledge of humankind and receive near instantaneous updates on the lives of friends far and wide. And adding to the measurement challenge, many of these services are free, which is to say, not explicitly priced. How should we value the luxury of never needing to ask for directions? Or the peace and tranquility afforded by speedy resolution of those contentious arguments over the trivia of the moment? Researchers have tried to answer these questions in various ways. For example, Fed researchers have recently proposed a novel approach to measuring the value of services consumers derive from cell phones and other devices based on the volume of data flowing over those connections. Taking their accounting at face value, GDP growth would have been about a half percentage point higher since 2007, an appreciable change, and that would be very good news. Growth over the previous couple of decades would also have been about a quarter percentage point higher as well, implying that measurement changes of this sort likely account for only part of the productivity slowdown in the current statistics. Research in this area is at an early stage, but this example illustrates the depth of analysis supporting our data-dependent decision-making. Let me now turn to the measurement issues raised from the measurement issues raised by the information age to an issue that has long been at the center of monetary policy making. How tight is the labor market? Answering this question is central to our outlook for both of our dual mandate goals of maximum employment and stable prices. While this topic is always front and center in our thinking, I'm raising it today to illustrate how we're using big data to inform policymaking. Until recently, the official data showed job gains over the year through March 19 of about 210,000 per month, which is far higher than necessary to absorb new entrants into the labor force and thus hold the unemployment rate constant. In August, the BLS publicly previewed the benchmark data revision coming in February 2020, and the news was that job gains over this period were more like 170,000 per month, a meaningfully lower number that itself remains subject to revision. The pace of job gains is hard to pin down in real time, largely because of the dynamism of our economy. Many new businesses open and close every month, creating some jobs and ending others, and definitive data on this turnover arrive with a substantial lag. Thus, initial data are, in part, sophisticated guesses based on what is known as the birth-death model of firms. Several years ago, we began a collaboration with the payroll processing firm ADP to construct a measure of payroll employment from their data set, which covers about 20% of the nation's private workforce and is available to us with roughly a one-week delay. As described in a recent research paper, we constructed a measure that provides an independent read on payroll employment that complements the official statistics. While experience is still limited with the new measure, we find promising evidence that it can refine our real-time picture of job gains. For example, in the first 8 months of 2008, as the recession was getting underway, the official monthly employment data showed total job losses of about 750,000. A later benchmark revision told a much bleaker story, with declines of about 1.5 million. Our new measure, had it been available in 2008, would have been much closer to the revised data, alerting us that the job situation might be considerably worse than the official data suggested. We believe that the new measure may help us better understand job market conditions in real time. The preview of the BLS benchmark revision leaves average jobs gains over the year through March above the pace required to accommodate growth in the workforce over time. But where we had seen a booming job market, we now see more moderate growth. The benchmark revision will not directly affect data for job gains since March, but experience with past revisions suggests that some part of the benchmark likely will carry forward. Thus, the current reported job gains of 157,000 per month on average over the past 3 months may well be revised somewhat lower. Based on a range of data and analysis, including our new measure, we now judge that even allowing for such a revision, job gains remain above the level required to provide jobs for new entrants to the job market over time. Of course, the pace of job gains is only one of many job market issues that figure into our assessment of the economy and how it's performing relative to our maximum employment mandate, as well as our assessment of any inflationary pressures arising in the job market. In summary, data dependence is and always has been at the heart of policymaking at the Fed. We are always seeking out new and better sources of information and refining our analysis of that information to keep us abreast of conditions as our economy constantly reinvents itself. Before wrapping up, I will discuss recent developments in money markets and the current stance of monetary policy. Our influence on the financial conditions that affect employment and inflation is indirect. The Federal Reserve sets two overnight interest rates, the interest rate paid on banks' reserve balances and the rate on our reverse repurchase agreements. We use these two administered rates to keep a market-determined rate, the federal funds rate, within a target range set by the FOMC. We rely on financial markets to transmit these rates through a variety of channels to the rates paid by households and businesses and to financial conditions more broadly. In mid-September, an important channel in the transmission process, wholesale funding markets, exhibited unexpectedly intense volatility. Payments to meet corporate tax obligations and to purchase Treasury securities triggered notable liquidity pressures in money markets. Overnight interest rates spiked, and the effective federal funds rate briefly moved above the FOMC's target range. To counter these pressures, we began conducting temporary open market operations. These operations have kept the federal funds rate in the target range and have alleviated money market strains more generally. While a range of factors may have contributed to these developments, it is clear that without a sufficient quantity of reserves in the banking system, even routine increases in funding pressures can lead to outsized movements in money market interest rates. This volatility can impede the effective implementation of monetary policy, and we are addressing it. Indeed, my colleagues and I will soon announce measures to add to the supply of reserves over time. Consistent with the decision we made in January, our goal is to provide an ample supply of reserves to ensure that control of the federal funds rate and other short-term interest rates is exercised primarily by setting our administered rates and not through frequent market operations. Of course, we will not hesitate to conduct temporary operations if needed to foster trading in the federal funds market at rates within the target range. Reserve balances are one among several items on the liability side of the Fed's balance sheet, and demand for these liabilities, notably currency in circulation, grows over time. Hence, increasing the supply of reserves or even maintaining a given level over time requires us to increase the size of our balance sheet. As we indicated in our March statement on balance sheet normalization, at some point we will begin increasing our securities holdings to maintain an appropriate level of reserves. That time is now upon us. I want to emphasize that growth of our balance sheet for reserve management purposes should in no way be confused with the large-scale asset purchase programs that we deployed after the financial crisis. Neither the recent technical issues nor the purchases of Treasury bills we are contemplating to resolve them should materially alter the stance of monetary policy, to which I now turn. Our goal in monetary policy is to promote maximum employment and stable prices, which we interpret as inflation running closely around our symmetric 2% objective. At present, the jobs and inflation pictures are favorable. Many indicators show a historically strong labor market with solid job gains, unemployment at a half-century low, and rising prime-age labor force participation. Wages are rising, especially for those with lower-paying jobs. Inflation is somewhat below our symmetric 2% objective, but has been gradually firming over the past few months. FOMC participants continue to see a sustained expansion of economic activity, strong labor market conditions, and inflation near our symmetric 2% objective as most likely. Many outside forecasters agree. But there are risks to this favorable outlook, principally from global developments. Growth around much of the world has weakened over the past year and a half, and uncertainties around trade, Brexit, and other issues pose risks to the outlook. As those factors have evolved, my colleagues and I have shifted our views about appropriate monetary policy toward a lower path for the federal funds rate and have lowered its target range by 50 basis points. We believe that our policy actions are providing support for the outlook. Looking ahead, policy is not on a preset course. The next FOMC meeting is several weeks away, and we will be carefully monitoring incoming information. We will be data dependent, assessing the outlook and risks to the outlook on a meeting-by-meeting basis. Taking all of that into account, we will act as appropriate to support continued growth, a strong job market, and inflation moving back to our symmetric 2% objective. Thank you, and I'll look forward to our questions.
Thank you, Jay. And we do take cards as well as the NABE app. So I would start just to reiterate in terms of data dependency, the importance of the BEA and the BLS. And it's been a long-standing interest for NABE to support those agencies. I'm curious if you could lend your support to those agencies as well.
I'd be delighted to. Our work depends really heavily on getting timely and accurate data, and also on being able to anticipate changes in the structure of the economy. It's an ever-evolving economy, and it's not as simple as just counting the things that are happening. When we're trying to assess how tight the labor market is or how strong GDP is, it really is an important challenge that enables policymakers to do a better job for the public. So I can hardly say too strongly how much we should support that activity. I'd also like to, again, support my colleagues in the industrial production group who work behind the scenes for a century now, and also all of the other terrific economists at the Fed. I'm sure people in this room would appreciate that they work very hard to serve the public all the time, and I'd like to call that out.
So in terms of being a pilot way up in your jet plane, it's very nice to have good indicators about what, in fact, you're flying through. I'm going to ask a more general question. I got the opportunity to go up to the Rocky Mountains National Park this weekend, and one of the things that the forestry world has learned is that if you go and you fight every fire that starts in a forest, one day you get a fire that it comes out of control. And they've learned that pre-burns are actually a really powerful way of controlling big systemic risk. And I'm curious, we're more than a decade into an expansion. As you mentioned, the unemployment rate is at a half-century low. Do you think that there's any sort of fuel building up in the forest of the financial system?
Well, let me start by saying it sounds like you had a more fun weekend than I did. So let me take that question another way, and then I'll come back to your question. I do think if you look through these long expansions, the one in the 90s and the current one, there have been periods where the economy slows and kind of gathers itself and then moves forward again. That was 95 and 98, those two episodes, and that was 15, 16, and I guess also a little bit of a slowdown earlier in the mid-teens. So in this expansion. So that is that's clearly a natural, it's part of these very long expansions that we've been having really for the last 40 years. And it seems to be a healthy thing. Clearly things are slowing a bit now. Growth is slowing closer to potential, and job growth is slowing as well, but it may just be gathering itself. There's no reason why the expansion can't continue. So, but in terms of the dry tinder question, we monitor financial stability conditions very carefully now, all the time. We have a division and that's responsible for that, and 4 briefings a year, regular quarterly briefings for the board and the FOMC, and ongoing monitoring. We published our framework so that everyone could see what we're looking at and hold us accountable. Not like this, the pre-crisis system was much more financial crisis happens, call in the SWAT team and try to stop it. So this is a much more forward-looking thing. So we look at leverage in the banking system, leverage in the non-financial system, asset prices, and the stability of funding. principally in the banking system, but not exclusively. And if you look across all of those today, I would say that the vulnerabilities to the financial system are moderate overall, which is to say not low and not high. There are vulnerabilities, and there are areas that we're carefully monitoring. Particularly, some asset prices have been high, and also corporate debt is an area. So in non-financial borrowing, you have household and you have businesses. Households are actually in good shape. Businesses are borrowing a lot, and it's something we've been monitoring carefully. But again, I'd say the vulnerabilities are moderate overall.
Great. So when you first became chair, you were spotted numerous times carrying Paul Volcker's book under your arm, and I'm curious what lessons did you learn from Paul Volcker, and what lessons are you taking through your chairmanship?
I've known Paul Volcker since I was an assistant secretary in the Treasury in 1992 or 1. And, of course, at that time, he had just relatively recently left the Fed, and I was frightened of even meeting him. I was so intimidated by this global figure. And he couldn't have been nicer and more interested in, helping me and supporting me. And we kind of kept up, and he was really, it was a great person to know. And I've read I've read numerous accounts of his life, but this book, if you haven't read it, I think really sums it up really well. I don't think there has been a greater public servant in our broad area in our lifetimes. I mean, he really just did exactly what he thought was the right thing all the time, and he let the chips fall where they may. He was famously booed at a Washington Bullets basketball game when he had rates very high, and they were then called the Bullets. So he's a great man. I'm still in touch with him, and so I actually thought I should buy 500 copies of this book and just hand them out at the Fed. I didn't do that, but it's a book I strongly recommend, and we can all hope to live up to some part of who he is.
Great. So one of the things that the Fed has been doing over the past year is a strategic review of its policy framework. Just recently, we had a Brookings conference discussing inflation and inflation targeting and a reevaluation of perhaps the framework there. I'm curious how that research and review is evolving and your thoughts there.
So I think it's evolving very well. This was something I really wanted to do as part of my time as chair, and a number of central banks around the world have done these external reviews in one form or another, and I thought it would be just a good idea, a good time and a good idea for us to do it. And then when Rich Clarida arrived, there were only 3 of us on the board at that time. We were just having a hard time, getting through the day. But Rich took this on at the very beginning and has been a great leader for this. So we're looking at our framework, our tools, and our communications. We began with a series of Fed Listens events at all 12 reserve banks. I think the last one I'm attending, the last one tomorrow in Kansas City. I think we've done 14 of those, and they're very different. And lots of them are live streamed, and we're hearing from the people we serve mainly. So it's people who work and live in low and moderate income communities. It's labor unions. It's small businesses, and really what a maximum employment and price stability and growth mean to them. And I have to say, if you listen to one of these things and sit through it, it's quite striking. It really does. I think it sheds a different kind of light than we might ordinarily get just from all of the economics that we study. So we take all that on board, and now we're going through a series of board meetings at which we're looking at things like makeup strategies for inflation and our toolkit and how we communicate, and we're going through those things one by one. I think we're making great progress, and I'm hopeful that we will. I think the exercise itself is a big win and a big gain for transparency and process, but I'm also hopeful, and I believe we'll be able to come out with some innovations which will put us in a better place to serve the public. And I'm also happy to see other central banks around the world are kind of picking up on the idea and doing it. So
Great. So you mentioned the toolkit, and certainly the toolkit over the last decade has expanded quite considerably for not just the Fed but other central banks. And as you consider the prospect of if we do see a full business cycle, what tools in that toolkit are you interested in using again? And then what tools do you not have in that toolkit that you hope to have?
As this audience will know well, the tools that we did use in the last financial crisis, of course, were rates, the federal funds rate, which we cut close to zero, effectively to zero. And then we also used fairly aggressively forward guidance, indicating that to the market, and this was at a time when the market was predicting lift-off and rate increases that were higher than the committee thought were appropriate, committed sort of semi-commitments to hold rates low for a long time. So that worked. And also large-scale asset purchases of longer-term securities, so which are a way of lowering long-term interest rates to support economic activity. So those are, I guess we need to stop calling them unconventional tools at some point, but those are the two new tools that we used during the financial crisis. I'm sure that we would use them again as needed and as appropriate. We don't see that now. We looked carefully at negative interest rates. I don't think that's something, I know it's something we didn't see as an ideal tool in our institutional context, and I think different central banks around the world did different things, and we can observe how those things work. But I don't think we regard that as a first-order tool or something we'd be likely to use. There are other things that we need to look at, and I would say yield curve control, sort of short-term yield curve control, is something worth looking at. It's not at all something we haven't looked at it, but it'll be something that we look at when the time comes. And the last thing I'll say is I think our toolkit, we'll use it aggressively to the extent we need to to achieve our mandate.
So one of the questions I got from someone today who knew I was going to be asking you questions was, is there an unintended consequence of, in a sort of reasonable growth, low unemployment, near the target rate, inflation rate, is there an unintended consequence of easing into that environment? Does it actually signal a risk-off environment to participants or consumers, et cetera, and does it actually almost become a self-fulfilling prophecy?
I don't think we see that in the data. I mean, in theory, that's possible. I don't think we see it in the data. I do look at this as akin to the two instances in the 1990s when the Fed cut and then cut again and then cut a third time. In those cases, that happened to be the right thing, that they thought that was the right thing to do. So provided some support for the economy, and the economy took that accommodation on board and gathered steam again, and the expansion continued. So that's the spirit in which we're doing this. I don't see any evidence that monetary policy is reducing consumer confidence or business confidence, which seems to be focused more on other issues.
One of the dynamics over the years, especially following the GFC, was policy coordination amongst the global central banks, the BOJ, the ECB, the Bank of England, the Fed, even to some extent the PBOC. And what are your thoughts on policy coordination going forward? What systems are in place?
In a crisis situation, there needs to be, obviously, a lot of deep knowledge about what's going on in economies around the world and coordination where it's appropriate. So I think of the swap lines, the dollar swap lines were clearly a key in keeping dollar funding markets working. In peacetime, in times like today where we're not in crisis, we do keep in very close touch with central banks around the world, and I think that's a very healthy thing. Coordination, the first step is transparency, and we all try to be very transparent so that our moves are well understood. Coordination, I think, really arises in the state of crisis, and so we don't actively coordinate now, but we try to explain ourselves to the public and hence to each other.
All right. One of the negative of having an electronic device that people can upvote questions is that there's a question that's getting upvoted about how monetary policy and climate change inform one another. Maybe I'll read the question directly, but any thoughts on that?
Sure. So climate change is very important issue, in my way of thinking, for countries and governments to deal with around the world. It's as I said, it's an absolute first-order issue as far as I'm concerned. Less obvious is that it's a first-order business for central banks. I think the main responsibility for climate change now, dealing with climate change, resides with legislatures and particular agencies that are focused on the economy. However, I think we are learning that financial markets and financial institutions are important, transmission into the economy of policies of various sorts. And central banks around the world are starting to think more about how and whether central banks should play a direct role in climate change. I'd say we're not there yet. We're not in a place where I think we would conduct monetary policy in order to deal with climate change type issues. But there's a lot of forward thinking and analysis going on. Of course, in bank supervision, we already supervise financial institutions in areas that are subject to severe weather, which is possibly related to climate change. We already require them to have plans to deal with severe weather, redundancies, and resilience to what can happen in for example, a hurricane. So in that sense, it's already kind of endogenous to our supervision work. But I think it's an important work, and we're going to be following carefully developments around the world on that.
So a lot of questions about the repo market, as you're probably not surprised to hear. And essentially, the question that is percolating through this room and the financial markets is, what is the repo market telling us? Why are the banks in what we're seeing in terms of the spikes in the repo markets, the need to do some intervention from the Federal Reserve, and is the Fed almost coming back into QE, or would you describe this intervention as something different?
Let's start there. This is not QE. In no sense is this QE. This is nothing like it all. This is I'll come back to that point, but I really wanted to make sure.
Yes, I
didn't want to forget to say that.
Right.
So if you go back, the quantity of reserves in the banking system peaked at about $2.8 trillion at the end of 2014 when we finished doing quantitative easing. And then due to increases in other reserves and also just to the increases in non-reserve liabilities really declined. While we held the balance sheet constant, reserves were actually shrinking down to, I guess, about $2.4 trillion when, under Chair Yellen, we began normalizing, actually shrinking the balance sheet, letting assets run off very, very gradually. So that went on. And then in March of this year, we tapered that. And in, I guess, July of this year, we stopped. And I think through all of that, we were moving quite gradually, and we were carefully talking to the banks and doing surveys and trying to assess what would be their lowest comfortable level of reserves, add all that up, and then put a big buffer on top of it. I think doing that work, checking it twice, led us to, and also watching the markets, led us to think that we were still probably away from a minimum level of reserves. And let me define what that is. We've committed to a system of ample reserves, and that means that we'll be able to conduct monetary policy, keep the federal funds rate in its range without resorting to open market operations all the time. So I think it very much looked like we were still a bit perhaps above that until September, when we found that we probably weren't.
Yeah.
And so we found that out, and so there are a number of explanations. It can be that reserves are just kind of less flexible. The quantity of reserves are less fluid, less flexible in the markets than we had anticipated. In any case, there are a number of possible explanations, and I think a plan to get us to our goal is going to need to take all of those on board over time. So we're working on just such a plan, and as I mentioned, we'll announce it soon when it's ready. It's not ready yet, but we're very much making great progress on that. And the idea will be to add enough reserves back in so that reserves will, of course, move up and down during the course of the year, and they'll also go up over time as the balance sheet expands. But reserves move around quite a bit during the course of a year. they have to be at a level so that their lowest level during the year will not be below the level that's needed to allow us to operate in an ample reserve regime. And we think that level might be at or maybe a bit above where we were in early September of this year. We think that. All of this is, though, uncertain. We're still learning. So we'll be adding reserves back in when we announce our plan to get back to something like that level. Of course, we'll continue to use open market operations to the extent we need to for as long as we need to. The main thing is this is very important for the financial markets, and we will do what we have to do to secure the transmission of monetary policy. It doesn't actually, as long as we do that, it actually doesn't have much implications for the economy, for financial conditions, or for the people we serve.
Wonderful, great. And I think that they're taking cards, is that right? Yeah, okay, if folks have cards.
But not QE. Did I mention that?
Not QE, you did mention that.
All right.
You did mention that. So I will ask you the same question I asked you a year ago, which is your thoughts on the yield curve. So now we were starting to see the curve flatten a year ago. Today it is an inverted curve. And what are your thoughts at this point on what the yield curve is telling us?
So the yield curve is one of a large number of financial conditions that we actively monitor. It's not, there is no single financial condition that really dominates all the others, but that's one that we certainly do monitor. And I guess we know why, we know what short rates are doing. Short rates are really reflecting what they think the Fed's going to do. Really the question is what are longer rates saying? And they're saying a lot of different things. There's a term premium there, which is about risk on, risk off, that moves up and down in different states of sentiment, market sentiment. There's also some sort of an assessment, though, in there about what the neutral rate is in the longer run. And so we look carefully at that and try to see if we think policy is above the market's estimate of the neutral rate, then policy is tight. And so we have to sort of assess that. But so when the curve is inverted, we focus very carefully on that, and it's not something that you need to deal with immediately, but it is something that it wouldn't be comfortable to be in that state of affairs for an extended period of time, of course. But again, it's one of many conditions. I hope that's what I said last year, by the way.
I think so.
All right.
I think so. All right. So the Fed has consistently characterized inflation as too low. Given that core CPI is at the highest level since 2008, and the Fed's preferred measure, core PCE, the 6-month annualized rate is above 2%, do you anticipate changing your assessment of inflation?
I would like to change my assessment of inflation. I would like to see it move symmetrically around 2%. And in PCE and core PCE terms, it still hasn't done that. We've seen it. Take core PCE, which is a better indicator of future inflation than regular PCE, although regular PCE is, of course, our goal. So you take core inflation, it's moved up and just kind of touched 2% and then moved back down to well below 2% in the first quarter of this year. It's now moving back up. I guess the real question is, why do we care? It's essentially, it appears to be centered a few tenths below 2%. And the reason we care is not that 2 or 3 tenths of inflation really makes a big difference. The issue is more the broader context. We want inflation expectations to be centered right at 2%, and we really want to hammer that point and make sure that they are. Because we look around the world and we see disinflationary forces in Japan and Western Europe, where you see inflation moving down, expectations move down, inflation moves down, and it's been very, very hard for economies to get off that road once they're on it. And so we don't want to get on that road. We don't think we're going to be exempt to these disinflationary pressures over time. We've got an aging population, as others do, and I think some of the same characteristics to our economy. So for that reason, we want to keep inflation at 2%. And it's not easy to explain that to the general public who don't really care whether inflation is 1.7 or 2%. But in our case, we think to serve them better, we need to anchor inflation at 2% so that it doesn't begin that inexorable slide down.
So when you come in to the office every day, or as you travel through your day-to-day life. I am curious what your dashboard looks like. What are you looking at on your dashboard to give you an indication of where your ship is or your plane is heading? So are you looking at, you mentioned industrial production, you mentioned productivity, inflation. Are there external factors like rest of world growth indicators? What are the things that are your touchstones that are most important on your dashboard?
You know, it's there's a lot of things on the dashboard, I would say. I try to do a deep dive on the economy. Mostly every weekend, I'll spend a whole day reading everything that I haven't been able to read during the week about what's going on in the U.S. economy, and that means reading the data releases and the analysis of the data releases by many of you here in this room, and also around the world, also globally, following data and following markets and that kind of thing. So that's the kind of thing you can do on a long, quiet day when you don't have meetings all day long. So that's a big part of it. I also think right now the broader sort of geopolitical risks are important right now, and you have to be watching those carefully and trying to assess the implication of those. I watch markets very carefully. I have a screen in my office where I don't sit there watching it all day, but you check in several times a day to look at what's happening in all the various markets that we all probably follow. So it's essentially, I look at everything in a way, and as I imagine many of us do.
So the Fed's role is not a social welfare role, but many would argue that the fall in the unemployment rate, the re-engagement of many people within the labor market who are out on the edges, that what we're seeing over the last couple of years has been extremely positive for the U.S. economy and the U.S. population. Is that something that is taken into consideration, that if we can continue to run the economy a little bit hot, that it could be quite a positive?
I would say that I see that aspect of the current situation as a very positive one. I guess I would question the concept of running the economy hot. I think we've learned that the unemployment rate can just be lower than we anticipated. Even than 5 or 6 or 10 years ago, it's significantly lower, and yet we don't see wages rising in a way that is out of keeping with productivity and inflation. And we do see businesses saying that they see workers as scarce. We see workers saying that they believe jobs are plentiful. Those are good things. We see prime age labor force participation going up. We talk to people in those low and moderate income communities at the Fed Listens events, and they say that this is the best economy they've seen in their lifetimes. So I would say I put a very high priority on wanting to continue that. I really do. But I guess I do a little bit balk at the idea that we're running the economy hot. This feels very sustainable. There's no aspect of the economy that is just booming. It's just, you've got a solid consumer sector where wages are going up, but they're going up right about at the level of productivity plus inflation. Job creation is healthy. There's no one sector that is, that like a housing bubble. There's nothing like that. There's no financial bubble. So it's a fairly sustainable economy. There are concerns around, business investment and manufacturing and trade, of course. But I would say we don't get to see the 11th year of an expansion very often, and there's a lot to like about it, particularly for people at the lower end of the wage scale who are getting now the highest increases, and it would be great to see it continue.
Right. So one of the, if we look at the markets, we see that the purchasing of insurance to hedge inflation risk is at all-time lows or extremely benign. But at the same time, we're in the midst of starting to increase tariffs on China. We're seeing several rounds that are going to come through. As that starts to show up in the CPI prints, et cetera, how does the Fed respond to those?
I think the basic approach to that for me would be that an increase in tariffs is, if it flows through to the consumer, is perhaps a one-time increase in prices. which is a different thing from inflation. As long as one-time increases in prices don't carry through into inflation expectations, then you don't actually have an increase in inflation. So now it's clear that if you look back at the history of the 70s with the oil crisis, some of those shocks can affect, if they're sustained and repeated, they actually can get into people's inflation expectations. We're a long way from that, though. If you look around the world, disinflationary pressures everywhere you look in advanced economies. It feels like the problem of this era is to keep inflation from moving down and try to keep it at 2%. Now, of course, if that changes, then we'll know it pretty quickly and we'll know what to do.
Great. Well, Chair Powell, thank you very much. We really appreciate it.
Thank you.